Bond yields are falling. Bonds themselves are rising. The Fed is arguably done raising interest rates, and the markets are becoming increasingly convinced that they're going to cut them more and sooner than even recent expectations had it. And the big winner from all of this commotion is likely to be perhaps a bit of a different market than you're expecting. This is Ilya Spivak, head of global macro for tastylive, and this is Macro Money. We are going to today focus on a story that hopefully sets up a longer lasting conversation for us, probably for the next year, and that is which assets are going to do exceedingly well in an environment where interest rates are tracking the other way after a blistering rate hike cycle. And make the argument that actually the place that might have the most acute opportunity to capitalize, of all things, is the Japanese yen. Let's start with the idea that's been circulating around the markets for about a year now, holding that perhaps now, with inflation up, Japan will finally abandon its decades-old ultra-loose monetary policy, and that this will revive the yen and give it new life. As we'll find out here, that almost certainly is not on the menu. First, let's take a look at growth. We are seeing here that for the third quarter, and we'll get an update of this in just about 24 hours here as updated figures come out, with no expectations for a meaningful change, that in the third quarter, Japan's economy shrank at an annualized rate of 2.1%. That's the worst performance since the first quarter of 2022. So clearly here, Japan is in trouble. This would be the second worst quarter of economic growth since the pandemic. That first quarter of 2022 was the recent low for economic growth. You can see the lowest rate before that was the COVID bottom in June of 2020, that is. And so you're looking here at an economy that's very clearly under pressure. When you look at the components of GDP, the story becomes even more dire. So I've broken it out here on a quarter-on-quarter basis between the private sector, the public sector, and net exports. The idea being that what we're looking at here is domestic demand versus external demand and where that demand is coming from. We can see that the public sector situation has been very anemic for the past several quarters. It's only been a minor contributor this way or that at all last year or this year. The big question has been domestic private sector demand, whereas the export side has been fickle. When we look in particular at the domestic demand part of it, the striking thing is for the past 2 quarters, it's been a negative contributor to GDP growth. And so were there not a surge of exports in the second quarter, we would be looking at already negative growth there. So the unraveling here tellingly occurring at home without the opportunity to really blame much on weakening demand externally, which is, of course, an important caveat because externally we've had a significant slowdown in economic growth for all of Japan's main export markets around their aggressive rate hike cycles to battle inflation, something Japan has not done. But despite the fact that they have not meaningfully pushed back on prices, it's domestic demand in Japan that's been driving the economy down for the past 2 quarters. It continues to look dire as we go into the 4th quarter here. This is the leading PMI data, and we can see that for the past 2 months, October and November, that composite index continues to deteriorate. Services are still growing a bit, but manufacturing is tellingly in contraction territory. So for the next 2 months here, at least leading into what 4th quarter GDP might look like, we see the economy is contracting. As ever, this is in the logic of PMIs. So 50 is neutral, above 50 is growth, below 50 is contraction. And we can see that composite index that subsumes within it both services and manufacturing and weighs them based on their contribution to economic growth. That's at 49.6. That is, it is below 50. So it is telling us that economic activity in Japan is at this point shrinking. So the story continues to get worse here after what have been 2 troubled quarters in the 2nd and 3rd of this year. What's more, the weakness is turning out more acute than the markets have expected. This is the Citigroup Economic Surprise Index, and it's showing us that from about the beginning of October, Japanese economic data has actually underperformed increasingly relative to baseline forecasts. So not only is the economy doing poorly, it is doing worse than the markets thought it would. Now, on top of this weak growth story, there is the inflation story. And of course, this is mainly where the grand argument around Japan needs to normalize monetary policy, this is where it finds its root. The last CPI number here came in at 3.3%. That would make it the 19th consecutive month that inflation has run hotter than the Bank of Japan's 2% target. And so it's becoming increasingly difficult to say we don't need to do anything about this, because inflation is now running meaningfully hotter for quite a while. And from the perspective of the Bank of Japan, of course, there is a credibility question to do nothing when you overshoot for so long. And yet, they seem inclined to stand aside because of where this inflation comes from. Consider that large yellow area there. That's food inflation. You take that out, and the rest of the whole adds up to just a 0.6% inflation rate. Whereas the contribution here from the food side of the equation is a hefty 2.3% out of the 3.2 that we're looking at here. And so naturally the question comes, well, what's the Bank of Japan going to do about food inflation? Less than 40% of Japan's food is produced at home. That means that more than 60% of it is imported. So the rising price of food is much more about imports and much less about anything that's happening with sustainable inflation at home. Now, from the perspective of the Bank of Japan, there's not a whole lot to be done about this without somehow hurting a different part of the economy. Now, to be sure, part of this equation is almost certainly the weak yen. And if the yen were to go up, the price of imported food in yen terms would decline. So that would help here. Of course, that would also hurt export industries in Japan, which, as we can see from looking at the GDP numbers, can be a game changer for economic growth numbers. So looking at all of this, on the one hand, gives the Bank of Japan some agency, but on the other, exerts on it tremendous costs not to interfere. So we end up with a situation where most of the inflation seems to be coming from abroad. Most of it seems to be the kind of thing that you couldn't really substitute around because you couldn't really tell people not to eat. And you don't have capacity at home to make up the difference by shifting the consumption basket, or at least incentivizing a shift in the consumption basket for domestic food. There's just not enough of it. And so there's not really a whole lot that the Bank of Japan can do about this part of it, other than just wait for this to recede. And the general implication of what's been going on around markets and food inflation seems to suggest that indeed it is receding. So in the orange here is a United Nations measure of world food prices. And in the dark gray there is global CPI, which generally has followed, give or take, with where most major economies are heading, including Japan. And what we can see is that as food prices have peaked, CPI has followed with about a 7-month lag. First of all, this suggests that there's more disinflation to be done, because we can see here the orange line is leading in that direction, and the gray one is yet to follow. So there is room for food inflation to continue to decline everywhere. And of course, because it is mainly imported into Japan, that would mean that it should ease there too. And so when we put all of this together, we end up with a situation where growth is weak. It's mainly weak for domestic reasons. And the biggest contributor to inflation isn't much of anything that the BOJ can act on in earnest, and is probably already moving in the right direction by itself. So not surprisingly, expectations for policy in Japan are very, very modest, and in fact more modest now than they were when the central bank last convened at the end of October. So if we look at what the policy path calls for now, we see a negative rate persisting in Japan for at least the next 6 months. It looks like we might get off negative rates just barely, to the tune of a meager 8 basis points within a year's time. In 2 years, maybe we'll make it up to 30 basis points. In 3 years, maybe closer to 50. In other words, over the course of the next year, we get maybe the equivalent of just under a full rate hike. So to go from negative 10 basis points to a positive 10, give or take. So about a 20 basis point swing in rates. That's just shy of a standard issue 25 basis point hike for most economies. Maybe we get another one of them over the course of another year, and then maybe a third over the course of another year, to give us rates of around 50 basis points in 3 years' time. Now, if we consider that current U.S. interest rates are 5.5%, and we're somewhere in the range of 3 to 5 for most major economies, this is not the kind of thing that screams hawkishness. This is not a central bank that is going to create meaningful interest rate differentials favoring its currency. And just to quickly recap how that part works, for your typical currency, if interest rates are expected to be higher in the future, whether because the central bank is going to hike or because it's going to cut less than earlier anticipated, if for whatever reason the market's perception of future interest rates moves such that future rates are expected to be higher now than they were expected to be earlier, that typically is a lift for the relevant currency. That is because one person's borrowing cost is another's lending income. And when you own a currency where interest rates are expected to be higher in the future, that means lending it will confer a greater yield than earlier expected, which of course makes owning the currency attractive. That tends to make the currency go up. And so you'd think that the premise of a Japanese policy shift in a more hawkish direction would be the necessary conduit for any kind of yen gains. But all the evidence from weak growth to food-sensitive inflation to a shifting to a more dovish setting on the implied policy path, and for that policy path to call for a pittance of tightening in relative terms, none of it seems to scream that the yen is about to assert a meaningful improvement in its yield position relative to other currencies. But in fact, it is that very thing that is likely to give the yen strength. Not that the Bank of Japan is going to move to a more hawkish setting, but the reasons that it won't, for probably a long time, make the yen exactly the kind of currency that is probably going to benefit from the world that comes. And here's why. Inflation and, of course, in parallel interest rates have been falling in Japan for the better part of 50 years. Japan has tried to revive them to no avail. In fact, we can see here in the yellow is the Bank of Japan balance sheet as a percent of GDP. And what we see here is Japan has spent 130% of the size of the entire economy in what is essentially a large-scale cash injection. So what the BOJ is doing is it's going out there creating yen, creating bank reserves, buying from those banks assets, and then injecting cash into the system to try to make cash cheaper, to try to generate inflation, to try to get to their 2% target. But for this last pop, apparently thanks to food inflation imported from abroad, there hasn't been any inflation in Japan for decades. We can see it's been precipitously falling. And even the increasingly significant, increasingly aggressive pumping of money into Japan's economy from about 2010, 11 onward, such that now the Bank of Japan's balance sheet is 130 or so percent of GDP, even that has not moved the needle in a meaningful way. Why? Well, because there's no turning of the demographic forces that have anchored things here. What we can see is that from about 1988, 1989, Japan's working age population has been growing at an ever slower rate, and the average rate now is actually negative, which means that at this point, Japan's working age population is shrinking and has been shrinking for the past several years. This means that, needless to say, Japan is aging, and aging quickly. The median age in 2020 was 48. The prime peak consumption years for a person typically are somewhere between 35 and 55. This is household formation years, children having years. This is where lots of spending tends to occur. By that age, typically a person has been working for some time, accumulated some money, and has started to spend that money on building some kind of a family, some kind of a household, maybe buying some bigger ticket items like real estate, maybe starting to make some investments. Most consumption tends to peak around that age, after which time it tends to decelerate. And as people get older, they consume less and less, because the accumulative part tends to be over, or at least the peak of it. That gives us an average peak age of about 45. Japan has passed that already. At the pace it's going now, the average age will only get higher, and it will only get further away. Now, what this means is that Japan's population is not a population of significant consumers, and where consumption trends are going the wrong way, toward less consumption, not more. That, of course, is less of a throng of people buying whatever goods are available. So the pressure on the price of those things is not up, it's down. More and more things are on discount, because consumption is trending demographically in the wrong direction. And so, not surprisingly, there is no inflation. And because there is no inflation, interest rates are stuck at rock bottom now for decades. But what this means is that the markets trade the yen in a very different way from other currencies. What these rock bottom interest rates have allowed for is a trading strategy called the carry trade, whereby people go, and both domestically in Japan and overseas investors employ this tactic, is they go and they borrow in yen, which at these rock bottom interest rates costs next to nothing. They then take that borrowed yen and buy things that pay higher interest rates with it, typically denominated, of course, in other currencies. So they might buy corporate bonds in Europe or the US. They might buy other currencies that yield more. They might buy stocks with dividend yields that exceed the pittance of interest rates that are being paid in Japan. All of these things are contingent on a strategy whereby financing in yen terms costs next to nothing, and there are higher yields to be had elsewhere. The more those high yields grow higher, the weaker the yen gets, because more and more of it is then borrowed and sold to buy other things. And so what you get is this inverse relationship, this very acute inverse relationship between global interest rates and the yen. When interest rates outside Japan go up, that is as a magnet for yen sellers, because they go and they borrow more yen and then they sell that yen to buy things not in Japan, where interest rates are going up. But of course, the flip side of this is that when interest rates the world over stop going up and start going down, the trend is reversed. With things going in the opposite direction, people tend to unwind these positions, which means they sell the non-Japan assets that they bought on the premise that interest rates are going up and that the rates of return on those assets are generally going up. And they flip their exposure because, for whatever reason, interest rates don't tend to go down for good reasons. They tend to go down because economic growth has slowed, and so central banks begin to cut. That slowdown in economic growth begins to bring them lower even before central banks react, as a matter of fact, just because of weaker economic activity. You get lower inflation as a consequence. Interest rates then also come down. And then, of course, once central banks do this proactively, the thing goes the other way. That also means that the return, like dividend yield on growth-sensitive assets, is going to have a harder time compensating if those growth-sensitive assets are falling in whatever downturn is prompting central banks to start the cut. And so things like foreign corporate bonds, stocks, etc., if they're growth sensitive, as they often are, they tend to come down, and maybe the yield income isn't enough to offset that. Oftentimes it isn't. And so what tends to happen then is people sell their non-Japanese assets, convert the proceeds back into yen, and cover whatever yen loans they had. Whatever yen they borrowed, they pay it back. But the process of doing that means buying the yen back in the market, which makes the yen go up. And so what we find is a very curious relationship, and this is probably the sort of catch-all chart that really subsumes the entire story. In the gray and the orange are where the market thinks Japanese interest rates should be. That's in the gray. That's the 10-year OIS swap, overnight index swap. The orange is the official Japanese 10-year government bond yield, which nominally the Bank of Japan was capping with a threshold of 0.25% above zero, and now has effectively loosened those constraints and widened that gap to essentially 1% up or down around zero. Notice that when Japanese interest rates go up, the yen goes down. The yen is in the red there. This is not because we've had any rate hikes in Japan. It's because borrowing costs in Japan are not immune when the Federal Reserve raises interest rates, because as we've said many, many times on Overtime and on Macro Money and on all the various shows where we've discussed this before, when the Fed increases interest rates, it is increasing the cost of borrowing of the US dollar, which is the quintessential form of commercial exchange. According to the Bank of International Settlements, nearly 90% of global monetary transactions are settled in dollars. So when the Fed raises rates, it pushes up interest rates everywhere, because what it's doing is it's making all economic activity more expensive to finance. Now, when interest rates go up everywhere then, and that process is led by the Fed, it means they rise in Japan as well, but for no reasons linked to Japan's own actions. And so what you get is this pull to borrow yen and invest it into higher yielding things. And so you get this strange thing where even as Japanese rates go up, because they are being pulled there by external forces, the yen falls, because the very same forces are inspiring people to borrow yen and sell it, to buy these higher yielding things going up. We can see a spot here at the start of this year, late last year, where the gap widened so much. You can see here 46 basis points, the gap, that's the gray bars measuring the distance between the dark gray line and the orange one. Once that gap widened to 46 basis points and basically cracked the Bank of Japan's ceiling on the orange line and said, no, you cannot keep it within 25 basis points, right? That's right here. Here's 25 basis points where they had that cap. It was bumping against the cap and bumping against the cap, and the market was saying, but global interest rates are pulling you this way. But the Bank of Japan could not let this cap go, and then had to, because the pressure was too great, and they couldn't sustain it. And so the yen jumped when this happened, then promptly receded back down, because the gap receded. And as we can see, we are now at just 20 basis points. But what we see at this stage is not only has the gap receded, but rates themselves have started to come down, because what have we heard from every major central bank so far in November and in recent months more generally, is that rate hikes are ending. We've heard it from the Fed, the ECB, the Bank of England, the Reserve Bank of Australia, the Bank of Canada, you name it, they've said it. Bank of Canada just said it earlier today. And so yields themselves have started to come down in Japan and in the market's expectation of Japan, but again, for external reasons. And so the pressure is easing still further. And what do we see the yen doing? Reversing higher. So the process of unwinding yen short exposure with the start of a march toward an easing cycle and out of a tightening cycle has already started. And what we can see from looking at the yen here is it has been much, much higher than it is currently. So what we are looking at here seems to be a trend as old as the end of 2020, starting to perhaps find a bottom and venture higher in a more meaningful way, because the long-term adjustment higher in interest rates globally has probably run its course and is starting to turn in the opposite direction. And that is why the Japanese yen, of all things, may be the standout winner as global central banks change gears. Which will wrap up macro money for us for today. As ever, we are on Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, talking about what happened on Wall Street on a given day and what it means for what comes next. I'm back on with Chris for Futures Power Hour on Fridays, on with Tom and Tony for First Call on Sundays, writing for the news and insights portion of tastylive.com, and sporadically opining on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money will be back tomorrow. Happy trading.